this is exactly how I plan to profit from the volatility on corn using a short strangle. Now, there's one big thing to know is on March 10th we have the monthly USDA report where they show the export and I think the estimations going forward. So it's a pretty big report. It comes out every month. Last time it came out, I think it was I think February 10th was it. It wasn't much of an effect, but before that it was on here on Monday, January 12th, and you can see price dropped like 5% because of the report. Usually the first report of every year is the most crucial because it kind of summarizes all the numbers for the previous physical year of 2025. But who knows, from my experience, I would always rather wait until after the report to open a position because I know the report can create some volatility, price can go up, volatility can increase, and it can be really beneficial. But right now we still have a pretty good volatility on corn. So this is the 3-month CVol volatility. So it's closer to the upper range of this 3-month volatility, which is really good. And obviously we have better premiums as a result. Now, again, I'm going to be waiting until March 10th to make any kind of movement on this position. I'm looking at a short strangle because price largely has been moving within a side trend. There are no very bullish fundamentals or bearish fundamentals that are very strong. Price is just kind of jumping around and doing nothing really specific, right? So this is why I want to enter a position like this. Also, the skew between the call and the puts is pretty minimal. Usually calls are really much more expensive than the puts. Then you know that the market is way more directional. This is what we have with crude oil currently, natural gas. Usually that's the case. Gold, silver, because these things are they have a high volatility currently, and at the same time, all the risk is to the upside. So corn currently is somewhat of a different commodity in terms of its behavior. So this is why short strangle will make sense to me. So I'm looking at the 415 and 475 strangle, and obviously those strikes are going to change depending on what will happen with the price until March 10th, which is in exactly a week, right? But I'm looking at opening a position at around 45 days to expiration. Ideally, 8 contracts for every 100K that I manage in my family capital fund. And I want to, like I said, wait for March 10th. We'll take profit at 50% of credit, and I will roll out and further out of the money if one of the calls or of the puts is challenged. Again, if fundamentals will change, something crazy would happen, I will just either take the loss and get out of the position at least on one side of it. So it's also pretty important to note, but the price has been moving within this range for basically almost, let's see here, well, like 10-11 months at this point. So I don't expect price to just go up or down very strongly unless there's some crazy new fundamentals that we weren't expecting, but which is very unlikely. Now, if you look at what kind of credit we can get, so we'll look at 475, 415, and I chose these strikes because they're basically like all out of the money. So this is the 1 standard deviation strikes on the calls and on the puts, and it also gives us a really nice range where the price has been moving within the past 10-11 months, like we just talked about, right? And I'm looking at 51 days currently to expiration. This is the closest to 45, and if you look at 8 contracts, for example, for a 100K account, we can collect a minimum of $2,000, which is 2% on the entire account, and about $5,700 in margin requirements, which is pretty low, right? So if we take profit at 50%, we will profit about 1% on the account, and theta is about $62. So it will probably take about 16 days to get to the profit. But if volatility falls down, obviously it's going to be much quicker. We can be out of this position in like a week, 7 days. But again, I will wait until March 10th. I want to emphasize that point. I'm not opening anything right now. So I will go ahead and open a position here. This is a demo account. This is not real money. I just want to follow the position, see what's going on, and it also helps me make my decisions. So I just open it up, and I always open things on demo that I plan to open just to see what's going on, if they reached a certain profit, or if they kind of turn around and became big losers. It's just good practice, and I learn a lot this way. So we'll see what's going to happen. I'll keep you posted. I think it's a pretty good play. There was another good play. Let me see here. I think it was November 20th. I don't remember exactly what day. I think, or maybe it was on November 13th, where we had their monthly report coming out. There was price went up, volatility went up with it. I don't remember exactly what day was it, but it was at the end of the year. I think from October to December. And what happened is the news were just BS. It had nothing to do with the actual demand and supply balance going forward. It's just indicated some information about what happened previously in the year. So this is just volatility for nothing. And this was a good opportunity to sell a Strangle, and it would have worked out pretty well up until this report over here, which is, again, I wanted to wait because I will mention it again and again. The first monthly report for of the year for the grains, for soybean, for wheat, and for corn is always the most crucial one, and this is where price can move quite a lot, which it did for corn specifically. So we'll see what's going to happen. I'll keep you posted. Follow me if you want to see more ideas, and I'll keep sharing what I can, obviously, and I can share everything basically at this point of my career. So thank you again, and I will catch you in the next one.